Hello, with me today I have Alex Crooke, Portfolio Manager at Bankers Investment Trust. Good morning, Alex.
Hello. Yeah, very well, thanks.
First of all, can you explain what the investment trust's objective is and how it invests?
Yeah, so Bankers Investment Trust launched in 1888, so it's a very long-standing trust, and it was originally designed to bring world markets, international markets to smaller investors. And essentially that's what we're still doing. So we're access to global equity markets, so you're investing in shares of companies listed all over the world. And really the objective is to outperform sort of global benchmarks, but also to deliver a dividend that grows in real terms, so beats inflation over the long term.
Okay, so income and growth is the objective, but yield is only just ahead of MSCI World Index. Is it fair to say that growth is the dominant objective?
I think one has to be honest, yes, these days growth stocks, as it were, have been sort of in vogue for a decade now, have delivered the best performance, and there's some fantastic companies out there with really dominant market positions. So yes, I think primarily we're looking for growth through the investments we own, but we're also looking for the income that they generate. And I think the twin objectives are really important and have tested over the test of time, have delivered actually a very consistent return. So what we look for is companies that yield probably between sort of a few zero yielders, but between 1% and sort of 3.5%. We're not looking at high yield stocks, and that gives a yield on the portfolio of roughly 2.5%, which is a reasonable premium to global markets, which yield about 1.5%. But trying to look for companies that generate strong cash flow, and we feel those are the best companies, best managed, and the best positions to grow in the future, because that cash flow can fund obviously our dividends, which we pass through to shareholders, but it also allows that company to invest in acquisitions, to invest in capex, or to deleverage by paying down debt, and the equity becomes more valuable. So I think it's the right way of looking for interesting opportunities.
Okay, well, I mean, the trust has dividend hero status. Does this all come from dividends, or do you dip into capital as well? Is a rising dividend very important?
Yes, as you say, 57 years now of consecutive annual dividend growth since 1966 is a very long-term rate. You don't get that by dipping, paying predominantly out of capital. You have to really look to cover your dividend over the medium term. So in some years, yes, we might favour a lower yielding market, or we might favour some certain proportion of stocks which are lower yielding. But I think over the medium term, yes, you've got to cover your dividend with your underlying core cash flow. And so if we look last year, 2023, we did that. We had slightly more cash coming in than the dividend we paid out. This year, who knows? But it is broadly covered, yes.
Let's talk about the discount. So why has it been widening, and does the current 13.5% discount look attractive?
Yes, we've seen discounts really across the board. All investment trusts have widened in the last sort of probably 12 months, I think is probably safe to say. And I think maybe there are three key reasons. One is the most obvious one. There are more sellers than buyers. That's what makes a market. And I think that comes through, investors' perception, a little bit of more risk out there. So I think over the last 12 months, there's been plenty of worries about a recession. Interest rates have risen, and therefore economic activity broadly has slowed. The stock market's kept going up, but actually underlying, I think more investors are probably more worried than positive about markets, and therefore I think we've seen net sellers. Cash yields a lot more, so if you're selling and raising cash, you can get 5% or so in various accounts. So that's also as competition. And then finally, there's been, I think, quite a hot market, shall we say, in certain technology sectors, and maybe that's dragging a bit of net investment into those spaces. I think what we see over time, though, we saw this in 2000, 2001, post the TMT tech boom. We saw it in 2009 post the GFC. So at times of worry, discounts widen. When people get a bit more confident, they come back in again as there are more buyers than sellers. Again, these are fixed share trusts, as it were. The
portfolio holds nearly 200 stocks. Does that make it a one-stop shop for global equities?
I think that's exactly what we're trying to provide is a diverse portfolio. So I think the way to think about it is we've got 6 regional sleeves, as it were, regional allocations. Each one is managed by a specialist who predominantly sits in their region, so managed out of Tokyo, managed out of Singapore for Asia, and the US for the US portfolio. And they're picking about 20, 25 stocks. So we get to that sort of 160 number of stocks. So quite concentrated, 25 stocks in in the whole of Asia or the whole of Japan is a reasonably concentrated portfolio. But what we'd like is they're specialists, they know their markets really intimately.
Well, look, as you say, you outsource the stock picking to internal managers, but you take a view on asset allocation. So what sectors or geographies do you like at the moment, and why?
So I think one of the key ones, maybe if we start with sectors, technology has been an amazing growth driver now for a number of years, and certainly the last 6-12 months has been all about AI. But I think one of the sectors within technology which has been doing very well and we think will actually continue strongly is semiconductors. And this theme comes about through, I think, both some technological advances. The chips are getting ever smaller and ever more powerful, so there's another phase here of development coming through in new chip manufacturing. But there's also the aspect of reshoring technology, key technologies. Most chips are actually made in Taiwan, certainly the super sophisticated chips. And a lot of countries, America, Europe, Japan and China, are all wanting to have this specialty manufacturing onshore. So we're seeing a really strong capital expenditure program coming in, supported by governments and led by some of the key players. So I think we've got 5 or 6 companies in the portfolio really which are in that theme of semiconductor hardware and growth. I think other areas we really like, retail banking. So as interest rates have risen, we're seeing bank profitability rise. We don't see a bad debt cycle. So we really like that sector. And then finally, general insurance is a nice niche area. Again, as the cost of capital, cost of bonds has risen, we've seen capital come out of that sector and therefore pricing has improved. So again, there's opportunities there.
In terms of geographies, are there any that really sort of stick out, hot geographies at the moment?
Yeah, I think Japan is the one, I think, really. It's been pretty unloved for 2 or 3 decades. It hit the high of the market was 1989. We've just literally gone over that point. So it's been a long recovery, shall we say. But I think, a lot of work was done by President Abe sort of 10 years ago, I think, trying to reform the economy to really improve productivity, returns of companies. And we're seeing that come through now in terms of, principally independence of boards, really testing management to say, well, are these cross holdings right? Should we be concentrating on our core business and not expanding in other areas? And we're seeing all those benefits coming through. We're seeing, rising, I think, gently rising inflation, rising wages. So even though the economy has issues about demographics, a low birth rate, I still think actually the equity market looks good value, and we're seeing very strong returns coming through there.
Alex Crooke, Portfolio Manager at Bankers Investment Trust. Thanks very much for joining me today.
Thank you.